Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section C, and this is an application topic. Use the lower of cost and net realizable value, or the lower of cost or market approach to calculate the carrying amount of inventory. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. If you don't know much about our strategies, make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. We go over the key ingredients to passing the CPA exam. Among them is, again, diving straight into the questions instead of reading a textbook or watching videos, and also studying in the morning and reviewing every day and things like that. You'll learn a lot just by going and watching that webinar. Make sure you go check that out. Also, just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this, you like our other products, and you like our other videos, or if this is the first time you're seeing it, just remember that you can become a pro member and get access to the full 10-question videos and a whole bunch of other resources by going to SuperfastCPA.com, checking out that webinar, and of course, purchasing SuperfastCPA. So make sure you go check that all out. And with all that said, let's dive straight into the questions. All right, here we are at question 1. Something we always like to point out is read the last part of the question first. That's a great habit to be in. It doesn't always help, but it is, again, a good habit to be in because a lot of times that will give you context for what you're looking for throughout the rest of the question. So let's read this. Using the lower of cost and net realizable value method, what should be the carrying amount of the inventory reported on Greenfield's balance sheet? Okay, so this is one of those cases where it would be helpful because if you knew how to do the lower of cost and net realizable value method, then you would immediately know, okay, I'm doing that. And then as you read through this, you'll know what you're looking for. Greenfield Manufacturing has an inventory with a recorded cost of $200,000. At year end, the following information is available for the inventory. The current market selling price is $270,000. The estimated costs to complete the inventory and prepare it for sale are $40,000. The normal profit margin is 15% of the selling price. Okay, so again, with all that information, we have to figure out the carrying amount using the lower of cost and net realizable value method. Now, if you know how to calculate the net realizable value, then you're going to know how to do this really easily. If you don't remember how to do that, or if you haven't seen this before, that's okay. We're going to dive straight into the answer to learn how to do this because, again, we're using the questions to learn how to do this. So let's go ahead and go to the answer. All right, here we are. The answer is A, $200,000 is going to be the carrying amount using the lower of cost and net realizable value method. So let's walk through this. The lower of cost and net realizable value, or NRV, method requires the inventory to be recorded at the lower of its historical cost or its NRV. You know, that's pretty clear in the name, but what does that mean? Let's calculate the NRV. So NRV, just as a reminder, is the selling price, the expected selling price, less any costs or estimated costs to complete it and make it ready for selling. So estimated cost to complete and sell, that is what you're taking away from the selling price, and that will give you the net realizable value. So net realizable value in this case is the $270,000, that's the selling price, less the estimated cost to complete the inventory and prepare it for sale. So the net realizable value is $230,000. We compare that to the historical cost. So just a reminder, when it says what the cost is, it's talking about the historical cost. So lower of cost or net realizable value, you're comparing the historical cost, like what it's currently valued at in the inventory, to the net realizable value in this case. So historical cost, $200,000, net realizable value, $230,000. And again, this is the lower of, so the lower of these two is obviously the historical cost of $200,000. So the lower of cost or net realizable value is honestly pretty simple. I don't think you're going to struggle with this one too much on the exam. So we're going to do one more question just to kind of hit it home one more time. And then from there, we're going to talk about the lower of cost or market, which I think is more confusing and more complex. So let's do one more question for lower of market or NRV. All right, here we are at question 2. Using the lower of cost or net realizable value method, what should be the carrying amount of the inventory reported on Eastern's balance sheet? Okay, so if I'm being honest, I think just from doing the previous question, you could probably do this. So I'm going to read through this, but I want you to pause the video and do it yourself because, again, I think you could do it after just one question about lower of cost or net realizable value. So let's read through this and then you'll do it. Eastern Manufacturing Inc. has an inventory with a basis of $340,000 determined using the LIFO method. The replacement cost for this inventory is currently $325,000. At year end, Eastern has gathered the following information for the inventory. Estimated cost to complete the items, $50,000. Expected selling price, $450,000. Normal profit margin, 20% of the selling price. Okay, so with all that information, again, we have to, using the lower of cost or net realizable value method, determine the carrying amount of the inventory. There may be some things in here that weren't seen in the previous question, but think about what we did in the previous question, and I think you'll be able to do this. So again, pause the video and come back when you're ready. All right, here we are. The answer is C, $340,000. That's going to be the carrying amount using this method. So let's walk through this one more time. To determine the carrying amount, we calculate the net realizable value first, and then we compare it to the LIFO basis cost. And again, the LIFO basis cost is the historical cost, how much it is currently valued at. And so we're comparing it to the net realizable value. Step 1, again, is calculating the net realizable value. So we take the expected selling price of $450,000 and we subtract the estimated costs to complete it so that they can sell it. And that gives you $400,000. That's the net realizable value. And we compare that to the historical cost, which in this case is that LIFO basis. So $340,000 for the LIFO basis compared to the net realizable value of $400,000. Obviously, the historical cost, the LIFO basis cost, is $340,000, which means that's lower. So that's obviously going to be what we recorded at. We continue recording it at the historical cost rather than the net realizable value in this case. So again, not too difficult. You didn't need to take into account the profit margin. You didn't need to take into account any replacement cost. It's just the expected selling price less any costs that are needed to complete it so that they can sell it. So it's pretty easy for the net realizable value. Now that we've gone over the lower of cost or net realizable value, we're going to talk about the lower of cost or market, and I think this is more complicated, so let's go ahead and dive into that. All right, here we are at question 3. Let's read the last part. As always, using the lower of cost or market method, like I said, that's what we're doing now. What should be the carrying amount of the inventory reported on Rosewood's balance sheet? Okay, with that information, we go up to the top. Rosewood Corp has an inventory with a recorded cost of $180,000. The replacement cost for this inventory is $145,000. At year end, the company has gathered the following information. Expected selling price, $200,000. Estimated costs to dispose of the items, $20,000. Normal profit margin, 15% of the selling price. So with that information, we have to figure out the carrying amount with the lower of cost or market method instead of the lower of cost or net realizable value. If you've seen this before, you might have an idea how to do this, so go ahead and try. If you haven't seen this before, again, it's a little bit more complicated, a little bit more involved than the previous type of method that we were looking at. So if you don't know how to do it, that's okay. We're going to look at the answer together. All right, here we are. The answer is B, $150,000. That is the carrying amount of the inventory using the lower of cost or market method. So let's walk through this. You start the same with the lower of cost or market or the lower of cost or net realizable value. Both times you want to start by calculating the net realizable value. So we start by calculating the net realizable value, and that is the expected selling price less the estimated costs to dispose or to complete it, whatever the estimated costs are to be able to get rid of that item or sell it, whatever the case is, that's what you're going to subtract from the selling price. So the net realizable value here is $180,000. So again, that's the first step. With lower of cost or net realizable value, that's it. You're pretty much done. You just have to compare that to the historical cost. But with lower of cost or market, there's a lot more to it. So now that we've calculated the net realizable value, we can go to step 2. We need to calculate the market ceiling and the floor. The ceiling is really easy because we just calculated it. The ceiling is the net realizable value. So the ceiling is $180,000 here. Next, we have to calculate the market floor. The market floor is the net realizable value less, and this is all in parentheses, the expected selling price multiplied by the normal profit margin. So in this case, it's the net realizable value of $180,000 that we already calculated, less the $200,000 selling price that, again, was given up above, multiplied by the 15% profit margin that we were given. So that means it's $180,000 less $30,000. So our market floor is $150,000. So just remember this. The market ceiling is the net realizable value. The market floor is the net realizable value less the selling price multiplied by the profit margin. So those are two things you're going to need to know. Now we can go to step 3 and we can determine the market value. The market value is the middle value of the replacement cost, the ceiling, and the floor. So we need 3 numbers to be able to determine the market value. We need the ceiling, which we already calculated. We need the floor, which we also already calculated. And we need the replacement cost, which was given in the question. Usually, probably always, that's going to be given. You'll know how much they're expecting the replacement cost to be. So again, we have all 3 of these numbers. And with that, we can figure out the market value. And the market value is simply just the middle of the 3. So the floor, in this case, is the middle because it's between $180,000 and the replacement cost. I'm not saying the middle is the exact middle between $180,000 and $145,000. I'm saying whichever value is between the other two, that's the market value. So the middle value is $150,000 here. That's the market value. Now we can finally finish this up and compare the market value to the historical cost. The historical cost was $180,000 and the market value is $150,000. So with that, because we're doing the lower of cost or market, whichever one is lower is now going to be the carrying amount of the inventory. In this case, that's the market value. So $150,000 is now the carrying amount. So again, this isn't too difficult. You just need to remember how to get to it. You calculate the net realizable value. With that, you can then calculate the ceiling, which is the net realizable value. And you can calculate the floor, which you just take the net realizable value less the selling price multiplied by the profit margin, and that gives you the market floor. And then with the market floor, the market ceiling, and the replacement cost, you determine which one of those is in the middle. Whichever one is in the middle is the market cost or the market value, and you compare that to the historical cost, and that will let you know what the carrying amount of the inventory is. Again, it's not too difficult. We're going to do another question to kind of help that sink in. So let's go ahead and go to question 4. All right, here we are at question 4. Using the lower of cost or market method, again, we're using that. What should be the carrying amount of the inventory reported on Granite Ridge's balance sheet? Okay, pretty simple, same idea, but it looks like it's in a little bit different format. Granite Ridge Inc. has an inventory item with a recorded cost of $712,500, determined using the LIFO method. At year end, the replacement cost of this inventory item has dropped to $658,200 due to market fluctuations. The company estimates that the item could be sold for $890,000. However, the company would need to incur additional costs of $97,500 to prepare the item for sale and anticipates spending $22,500 in post-sale warranty claims. The normal profit margin for this type of product is 12% of the selling price. So again, with all that information, we need to figure out the carrying amount of the inventory using the lower of cost or market. Now, we just went over this. I talked about it a good amount. I think you should try to see if you can take what you just learned in question 3 and apply it here. If you get stuck, that's okay. Go ahead and unpause the video and we'll look at the answer together. But again, I want you to pause the video and do it yourself. See if you can do what we just did and come back when you're ready. All right, here we are. The answer is D, $685,700. That is the carrying amount of the inventory using the lower of cost or market. So let's walk through this. Again, we're going to do the steps over again so that you can see how we got there. First, you calculate the net realizable value. That's always the first step between these two methods. And again, that is the expected selling price less the estimated cost to prepare for sale. Notice we did not include the warranty expenses because that's post-sale. Like you've already sold the product. Those are going to be different expenses. These are expenses specifically for preparing it and selling it, things like that. So the net realizable value is $890,000, which was the selling price, less the $97,500 that was expected to be spent to be able to get it ready to be sold. So that's $792,500. That is the net realizable value. Now that we know that, we can go to step 2. We already know the ceiling because that is the net realizable value. So that's $792,500. And then the floor, you take the net realizable value and you subtract the expected selling price multiplied by the normal profit margin. So $792,500 less $890,000 multiplied by 12%, that gives you $792,500 less $106,800, and that's $685,700. So we know the ceiling, we know the floor, and now we can go to determine the market value. Remember, under the market value, you are comparing the 3, and whichever one is in the middle, that is the market value. So let's scroll down here just a little bit so we can see all of it. Okay, the ceiling was $792,500. The floor was $685,700, and the replacement cost was $658,200. So we can tell, and you might have to kind of move this around yourself, like kind of put it in this order so you can see which one is greatest and which one is least, so you can see which one's in the middle. The middle value is obviously this floor of $685,700. So that is the market value because that's the middle of the 3. So now that we know the market value, we can compare that to the historical cost of $712,500. And obviously between the two, the market value is the lesser of the 2. So the market value is what it's going to be recorded at the carrying amount for the inventory. So the carrying amount is now, instead of $712,500, it is $685,700 because that is the market value, which was less than the historical cost. So again, it's not too bad. You just need to make sure you follow the steps, figure out the net realizable value. Then using that, you can figure out the floor and the ceiling. And then you compare the floor, ceiling, and the replacement cost to find the market value. And then once you know the market value, you can compare that to the historical cost, and that will tell you what the carrying amount of the inventory should be. So with that, I think you probably know how to do this. So now let's go to the next question. All right, here we are at question 5. This one's a little bit more complicated. What is the carrying amount for the total inventory amount reported on Sunrise Manufacturing's balance sheet using the lower of cost or market method? But there's a little bit more here. Sunrise Manufacturing has 2 different inventory products that it reports at the lower of cost or market. The company uses a standard profit margin of 12% for both items. The following information is provided for each product. So product A had a historical cost of $420,000, a replacement cost of $380,000, an expected selling price of $470,000, and they have estimated costs to complete it and sell it of $50,000. For product B, they have a historical cost of $260,000, a replacement cost of $275,000, an expected selling price of $350,000, and estimated costs to complete and sell $40,000. So with all that information, we need to obviously figure out the lower of cost or market for product A and for product B so that we can then determine what the total carrying amount of the inventory is after you add those 2 up. So you're going to have to do it twice and then add up the carrying amount for each of them to be able to get this answer. So pause the video, go through this. Again, we've done this twice already, so I think you can figure out how to do this. Pause the video and come back when you're ready. We'll look at it together. All right, here we are. The answer is A, $640,000 is going to be the total inventory carrying amount once we've done the lower of cost or market for both of these products. So let's go down a little bit to see, so we can see all of it. So for product A, we have to figure out the market ceiling, which is the net realizable value, which you can calculate by taking the selling price less the estimated costs, which was $470,000 less $50,000. So $420,000 is the net realizable value. And now that we know that, we can figure out the market floor. We take the net realizable value and subtract the selling price multiplied by the profit margin. So we subtract $56,400 from the $420,000 net realizable value, and that gives us $363,600 for the market floor. So now we know the ceiling, now we know the floor, and the market value is going to be the middle value of these 3, which the replacement cost was given above, so hopefully you wrote that down as you were doing the calculation. The replacement cost is $380,000, so we can compare that to the ceiling and the floor, and we can see that the ceiling is obviously the biggest, the replacement cost is next, and then the floor is the lowest. So the middle value of the 3 is the replacement cost, so that's the market value for product A. Since the historical cost of $420,000 is higher than the market value of $380,000, product A should be reported at $380,000. That is the market value, which is the replacement cost. So now we know that for product A. Let's go to product B. Again, we have to figure out the ceiling, which is the net realizable value, which is the selling price, less any costs that were expected to be able to get it ready for selling and things like that. So that's $310,000 because $350,000 less $40,000 is $310,000. Using that, we can figure out the market floor, which is the net realizable value less the selling price multiplied by the profit margin. So $310,000 less $42,000 is $268,000. So that is the market floor. Now that we know the market ceiling and the market floor, we were given the replacement cost here, $275,000, and that is up in the question if you paid attention. So the middle of these 3 is, again, the replacement cost because the floor is less than the replacement cost, but the ceiling is greater than the replacement cost. So the replacement cost is the market value, again, in this case. So the market value is $275,000. Since the historical cost, which was $260,000 for the product B, is actually lower than the market value in this case, we use $260,000, which is the historical cost for product B. So now that we know that product B is valued at $260,000 and the product A is valued at $380,000, we can add those 2 together, and that gives us the total carrying amount of $640,000 for the inventory. But we had to calculate the lower of cost or market for both product A and for product B before we were able to do that. So I feel like you got a lot of good practice there from just these few questions that we've done. Before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, as a reminder, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice that certain things keep popping up in the questions. You've seen 3, 4, 5 questions trying to teach you how to do the lower of cost or market method, or you've seen 3 or 4 questions trying to teach you how to do the lower of cost or net realizable value method, or whatever the case may be. You keep seeing these things pop up in the questions, so you know they're important. You know this equation or this concept is important. So you take a moment and you summarize in your own words the pillar topics from what you learned from the questions so that you know them for test day. And as you go, you'll have pillar topics summarized each study session so that you know what is most important when it comes to the exam. Let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. let's go ahead and go through them. This is not a complicated topic. You just need to remember the steps to do it. So first, let's talk about the net realizable value because that is important for both of these methods. You calculate the net realizable value as the expected selling price less the estimated costs to complete and sell the inventory. So that is the net realizable value. And that's super important to know because for one of the methods, that's pretty much all you need to know. For the lower of cost or net realizable value, you just figure out the net realizable value, compare it to the historical cost, and you've got the answer right there. Now, it is also important for the lower of cost or market because let's go to market ceiling. The market ceiling is the net realizable value. This ensures that the inventory is not valued higher than the amount expected to be realized. So there's a reason that they have this ceiling because you want to make sure that the market value is not greater than what you're expecting to make from the sale. And then there's the market floor, which is also uses the net realizable value. We take the net realizable value less the expected selling price multiplied by the profit margin, and that again gives us the floor, and this prevents the inventory from being valued below a recoverable amount. And once we've figured out the market ceiling and the market floor, we can figure out the market value. The market value is the middle value of the replacement cost, the market ceiling, which again is the net realizable value, or the market floor, which again is the net realizable value less the selling price multiplied by the profit margin. Now, once you figured out the market value, it's compared to the historical cost, and the lower of the two is reported as the carrying amount if lower of cost or market is being used. So again, these aren't too complicated. Just remember, you always want to calculate the net realizable value between these two methods, and depending on if it's the lower of cost or net realizable value, you'll know the answer right away, or you'll need to use the net realizable value to calculate the market ceiling and the market floor so that you can figure out the market value. Again, not too difficult, just remember the steps that we went over in this video. And with all that, that is the end of the video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, we teach the key ingredients to passing the CPA exam, and it's free. It's only 1 hour long, so make sure you go check out that webinar. And if you liked this and you like our other videos, just remember that if you become a Superfast CPA Pro member, you will have access to the full 10-question videos that we post in the members forum because we only went over 5 questions here, but I'm about to go over another 5 questions after I end this video. So you'll be able to access that if you become a pro member of Superfast CPA. And of course, you'll get access to a whole bunch of other resources as well. So make sure you check out the webinar, make sure you check out the pro bundle. And with all that, I hope that you liked the video. If you did like it, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.